Ladies and gentlemen of the crypto space, we're live at 11:29 a.m. Thursday, March 18th. Basically the end of the week already. Oh my. If risk isn't considered, it's degenerate speculation. I know this is a hard-hitting statement, but if you hold an asset and you know it can go down, it is your responsibility to be prepared for it to go down, not with hodl. Not, I'm going to take a 20% hit on all of my money because I believe I'm making a difference. No, this isn't church. This is capitalism. You didn't get into crypto for the righteous. I mean, sure, there's a part of it, and you could participate in communities, and you could educate, and you could love assets. I love Digibyte. I'm just saying. That is some risk on business. Until there's dollar stablecoin pairings for REN DGB, you can't protect the downside. And if you can't protect the downside, you are taking excessive risk with your value. And you're talking about value if you're married and you have a mortgage and you have a car payment and you have kids. You're talking about value that you need. It's your responsibility as an adult to protect. These are important things. I wrote the other day on Twitter, this isn't a game. It's fun. And that's why these food memes drive me nuts. Because it attracts persons that want to play. It's not a game. So we could do better. 24 people in the stream, 3 likes. We could do better. It's time to do better. You love your assets. You could buy assets. You could trade assets. You could do whatever you want to do. But whatever you're doing, do better. Take a next step. Develop a strategy. Hold conviction to an ideology. Define rules. Stick by them. Hodling is not a rule. I mean, sure, if you want to be like totally no rules and just don't want to spend any time figuring this stuff out, take 10% of your paycheck, dollar cost average of the Bitcoin. That's a rule, though. That's a rule. I'm just saying that's a rule. You gotta have rules. Because if you don't have rules, it's just gambling. Just saying. Anyway, today's episode is sponsored by Change Angel, the non-custodial swap exchange for social goods. Stop depositing on exchanges, not your keys, not your crypto, non-custodial DeFi, or nothing at all. Bam! Let's pop it over to the main screen and see who's in the stream. Angela's in the house. Charlie G, always a pleasure. Larry, yo. Charlie, let's get it. Bhavin, morning, sir. Welcome. Enjoy. Mark's in the house. Simon is joining. Simon is a dear friend. Simon is a savant. He's brilliant. And that's probably all I need to say. Special friend. Welcome, Simon. Montana's in the house. Good morning, Noah et al. Yes. Flutter team is here. I welcome. Angelo, Simon, Smiley Face, Mark's in the house, Igor, Bhavin. What do you think of minimum amount of ACLX stake versus pairing ETH and LPing into Uni? Yeah, I'm not going to be able to give a specific answer to that. ALCX is a highly volatile asset. There's no deflationary component at the moment. You do have dollar protectiveness, I believe, with some of the stablecoin pairings where you can protect the downside. And that's going to be extremely important because it's been vertical. It's up a huge amount of value. When assets go up, they come down. They are volatile. If an asset goes up fast, that is volatile. So should you not be prepared for significant depreciation? Sure. So protect the downside. It's a risk-on asset, even and it's a relatively new asset. Doesn't mean I don't have any bad feelings about Alchemix. It's an absolutely ridiculous project that got some really good funding lately. And that's basically your free loan that I've talked about, that I've shown examples of with Aave. um, built into a smart contract platform. So I got really good feelings about the platform. Doesn't mean you're not taking excessive risk if you over position into ALCX. Position size is more critical than ever. Respect the portfolio and it will respect you. Scott's in the house. Always a pleasure. What a crew. I miss you guys. I miss those days. Well, we'll see. Maybe those days will come again. Um, Albeit, Solidity and Viper really calling my name, but it's just explosive nowadays. What's going on in the space? Cruz in the house. No, but Noah, it's not about my money. It's about sending a message. No, it is, but it's not. And you know what I'm saying, whether you've thought about it or not. It's both. And it's about respecting yourself more than you got to respect yourself more than you respect the message, any message you're trying to send to the establishment. You guys know damn well that I am angry at the establishment and the status quo, but you're going to get nowhere if you lose 50% of your value to an asset that depreciates significantly. I know plenty of people that threw like almost all their portfolio into Rook, and they're probably down like 50, 60% at this point. No, 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 no. Can't do that. Can't do that. Tyler, can you triple stake, die into Aave pool, into die curve pool, into urine? You could do a whole bunch of stuff. Bear in mind, as you take leverage, you're taking on additional risk. Um, so I don't know how to leverage dollars like that because everything is over collateralized. You would need under collateralized to be able to leverage dollars like that. But there's a lot of games that can be played, and that's the type of game that Alpha Homora V2 3 pool plays. But they're currently not lending at the moment. They had that security incident a month or two ago, which they've resolved by a very intelligent and well thought out compensation package that's built into their contracts with the Cream Iron Bank. But point being, that is something to consider. Dollars, if you're earning 30, 40, 50, 60, 80% on dollars, what the heck are you taking a risk on with volatile assets? See what I'm saying? Simon's in the house. My Noah, it's your birthday. I wish I was over there in the UK. Get you some drinks, my friend. ARV, Rook, FTW. Sure. 0.5% of your portfolio. It goes 20x on the money. That's great. You turn $1,000 into 20 grand, you win. But if you bet in 100% of your portfolio, 50% of your portfolio, and you got like 5 grand in crypto, and you got 2,500 bucks in Rook, and Rook takes another 50% haircut, that's gonna hurt. You got to be prepared for that. Squanchy. MEV extraction is going to be absolutely massive. Sure, but currently it's not. And currently there's the deflationary pressure on the asset. And just because MEV extraction is incredible and brilliant, I'm not quite sure how that fits into the value of Rook right now, unless there's a deflationary component. Or the Rook asset is tied to the functionality of the system. So it is, but loosely currently. It's a decaying inflationary asset. It needs the DAO. It needs voting. It needs incentivized supply disruption. It needs the monetary policy. And until then, it's highly speculative and will be highly volatile. Tell me about Cardano. Cardano has huge potential. Just tweeted about it earlier. A little bit tongue in cheek that it's up 26% today. Speculation. It's up because people think in a month or two, something big will happen that will substantiate the price action. So the market is forward looking, just like equities. Forward, stock market's like forward looking 10 years at this point. But the crypto space and Cardano has appreciated because it's forward looking a month. Cardano is a big deal. I look forward to smart contracts and DeFi platforms and that offer borrowing and lending capacity and collateralization opportunity and LP pools so that I could extract transaction yield, exchange volatility for yield, which is what LP positions do. And whether it's on Cardano, whether it's on Polkadot, a Cosmos Hub, Solana, Elrod, or Ethereum. Doesn't matter. Structure your portfolio, produce your yield, protect the downside, capitalize on volatility. Doesn't matter what platform it's on. What matters is if you respect your portfolio, it will respect you. Morning all, what's with Chi? Chi is brilliant. If you're doing any kind of transaction on Ethereum, the only logical place to do it is on 1inch with Chi. If you're not doing that, you're wasting money on gas. X30D. Noah, my man, Anchor Protocol by Luna Team, 20% fixed APY. So, yeah, it's been on my radar. Luna's been hot. Cool. I don't like new. I like tried and tested. I like things that have had a security incident and have recovered extremely well. So I hold Alpha Homora in high standard. I manage my risk, so I don't touch new things. Albeit there's insurance. You should have an ArmorFi policy, either that or a Nexus Mutual policy at this point. If you have value in DeFi, you need to insure your assets. So I got 3 months worth of collateral, topping up 183 grand worth of insurance on 1inch. This probably needs to be adjusted at this point, but that's the whole point. This is a DeFi insurance policy. Insure your risk. That's the number one thing to do. Rook basically owned by Amber Group, which offers percent on assets. Okay, I'm cool with that. Just, look into it and understand what that means and be careful. Heirlooms in the house, always a pleasure. Waves in the house, good day to you all. Carl says, I have 65 ADA and I am selling until it gets to 1,000. That's not the way to invest. What if it goes down? Are you prepared? What happens if you lose half your money? Just say. Sure, 2% of your portfolio, 65 ADA. You turn a couple of $1,000, 2 grand into 20 grand. Congratulations. But if it goes down, are you prepared for that volatility? What's your time horizon? What's your risk tolerance? This is why I just tweeted, and I've tweeted a couple of times, the dollar paired stablecoin LP positions are probably what most people want. And that is what I focus on predominantly. So it's called impermanent loss. So if you have Ethereum and USDC, you're not going to experience the full upside potential of Ethereum's appreciation if it goes up, but you're also not going to experience the full depreciation if it goes down. And that's the whole point. So impermanent loss has a phrase that is not talked about. It's called impermanent protection. Impermanent protection, ladies and gentlemen. LP positions that historically have been talked about. Oh, I'm gonna miss out on all those gains of Ethereum or whatever asset is paired with the dollar stablecoin. But you're also protecting the downside. Now, there's a time for risk on, there's a time for risk off, and these are all things that you have to gain a gut instinct for. Look, these charts look great, man. I mean, Bitcoin looks solid, dollar denominated on the daily. This thing's in a rising wedge and just hit a bullish signal cross on the Stoke. And MACD looks relatively good, has bullish, higher lows, bullishness. And same with the RSI. Look at that, above 60 on the daily. Bitcoin kind of fits its own narrative. It tells its own story. It carves its own path. And that is inarguable. Wall Street's talking about Bitcoin. They're also talking about Ethereum. I'm talking about other stuff that Grayscale has trust available for. But it's predominantly Bitcoin. The folks running around with $500 billion aren't talking about anything but Bitcoin. And if they do talk about anything else, it's not going to be a specific asset. It's going to be about yield, protection, insurance, risk management, volatility, risk mitigation and volatility mitigation strategies. They're going to talk about the monetary velocity that's occurring. That's what they're going to talk about, ladies and gentlemen, which is why exactly I always tell you to follow the monetary velocity. Listen, if there was $10 billion and $2 billion a day in transaction volume on Cardano, great. Happy for the platform. It did what everyone wanted it to do. Am I going to buy Cardano because I hope that it does that? No. Am I going to buy Cardano if Cardano had a stablecoin paired LP position where it was Cardano and USDC? Yes. Do I care if Cardano goes up 200% from now? No, I don't care. Do I care that I missed out on 200% gains? No, because there was too much risk in just holding the asset, hoping, expecting, speculating that it would appreciate. I don't want that speculation. I don't want that risk. I need to be able to sleep at night knowing that the downside is protected, and that is worth everything. Do you think the pension funds and the insurance companies are thinking about just upside? No, it's all about downside. Everyone, all they do is think about downside. Everyone in the ancient financial world, all the big money, all they do is risk management. That's it. All right, let's keep it going. Let's keep it going. Wait, I could get 50% on dollars? You see, Max, it changes everything, doesn't it? You could probably get around 50% on dollars if you push hard. I mean, literally, just go on Curve. You can play it automated vis-a-vis Yearn. I mean, do I have? I've shown it a couple of times. The Yearn strategies are basically just automated Curve LP positions, taking the incentivized yield, and Yearn has access to a lot of VE curves, so they're able to max out the incentivized yield. But I'll show you. Curve, look, 33% on dollars, on euros. Get 33% on Ethereum, 33% on MUSD, 34% on USD, 25%. Here, look, 50% on dollars. So there's your 50% on dollars. And 32% on SUSD. This is awesome. It changes everything. Doesn't that change everything? These are dollars, and these are relatively risk mitigated positions. And these are also risk mitigated smart contracts at this point. Urine is one, Bantag and the other folks and all the boys that have built this platform are some of the smartest people on the planet. I've looked at their source code. It is some of the cleanest source code I've ever seen. I was spectacularly impressed with the organization structure, syntax, and all the stuff that they put into it, even the commentary to describe various functions. Brilliant boys, brilliant boys. And Curve too. Curve, Yearn. These are the titans of industry. I've said it before. You watch Steve Jobs, you watch Bezos and their tiny garages and their tiny offices. That's what's occurring right here, right now. Curve, Yearn, 1inch, Uniswap, MakerDAO, Aave, even Kyber, Bancor, no doubt. These are titans of industry forming, being forged right in front of your eyes. They're building the foundation of a functional financial system with a monetary velocity, the capacity to borrow and lend permissionlessly. When folks talk about the decline of the legacy financial system, it really is surmised in many regards by the collapse of monetary velocity, M2 velocity. They're debasing M2, which means the velocity is plummeting because that's the denominator for monetary velocity is M2 supply. And the numerator is basically borrowing and lending and deposits and withdrawals. The velocity, metaphorically, obviously there's the technical substantiation, but metaphorically, think of monetary velocity as the movement of money. The movement of money is not keeping up with the quantity of money that is being introduced to the system. But in the DeFi space, that is not the case. The movement of money is overwhelmingly keeping up with and exceeding the amount of capital in the system. The monetary velocity is vertical, which means the yield is real. The yield is based on the monetary velocity, the capacity to capitalize on transaction fees, the capacity to lend the capacity to borrow and achieve leverage positions, maybe even a short position if desired. These are real phenomena, and it's quantifiable, the opportunity. And it's comparable to the legacy systems on why everything that's being built is viable. So it's not even about speculation. It's not about speculation what's occurring in DeFi. And DeFi has nothing to do with Ethereum, has nothing to do with Cardano, has nothing to do with Binance Smart Chain. You're taking your respective risks. If you're operating on Binance Smart Chain and you're a US citizen, you're operating in a platform that you might not get your value out of. You're not legally allowed to access that platform. It says so right on the warning of the Binance bridge. Take it for what it's worth. With great risk comes great reward. Depends on your risk tolerance. All I could ever advocate on this stream is minimize the shit out of your risks. Stop taking risks. You're operating in a bull market. I don't know how many people have seen 2018, 2019. I don't know how many people have seen 2015. When this thing goes down, it goes down hard. So unless you're prepared for that, unless you've structured a portfolio and learned how to operate in such environments, you're missing a critical part of your education, critical part of your skill set, and how to navigate such price action. Doesn't just go to the upside. And even intraday, intra-week, you got your volatility. Listen, this thing could break to the downside. Now, bear in mind, I mean, look at these guppies. Oh, my God. These guppies are incredible. This trend is, albeit it's looking like a bit of a head and shoulders, but this is a heck of of short-term moving averages going down to $1,500. And it just held on trend formation on the daily. We'll see in 8 hours if it holds. If it holds above this, this is an incredible chart. And so is Bitcoin. 59,000. That's about this is going to break a rising wedge to the upside. Bear in mind, in 2017, it did this many times. It broke to the upside. And you guys know the chart that matters most. Who cares about the dollar? M1. This is the chart that matters, boys and girls. And you see those red lines to the upside. And let's zoom out for ladies and gentlemen of the crypto space so you see where we are, not just in the market cycle. Bitcoin hasn't broke out. M1 is the base money of the United States dollar. And they introduced a lot of it in stimulus. So considering M1 denominated in M1, Bitcoin hasn't even broken out yet. Now, don't look at the Stoke. Plan B, we'll talk about it often. Stoke will just stay up there and look, you see what happened back here. It just stays up there. But RSI is what's pertinent. This is the 2019 peak. Is that 2018? 2018, 2019? It hasn't even broken the 2019 peak yet. So Bitcoin's just getting started, ladies and gentlemen. All right, let me try and answer some questions. I'm sorry, I'm missing a lot. First mover advantage, strong team who can adapt their tokenomics to monetary policy in the evolving MEV space. Sure. It'd be buy when it's going up. You buy things that are going up. You sell things that are going down. If you're buying something that's going down, hoping that it's going to go up, you got to see why that's wrong. You cut your losers loose and you double down on winners. You don't look for bottoms and you don't look for tops. Excessive risk in trying to do that. Speculative, but yes, same reason why I went hard on Ren. Ren's a different story. And most people went hard on Ren probably in 2020 in March, which was basically after Ren went critical mass and launched mainnet. That's a very different story. Rook isn't there yet. Got to risk the biscuit to understand the risk, sir. Yes, well said. You got to risk the biscuit. Are you prepared for the downside? Have you taken a 50% haircut already? Are you prepared to take another 50% haircut? Do you have a capacity to protect that downside with a dollar stablecoin paired position? If not, apply appropriate position sizing. 1% of the portfolio. You have 100 grand in crypto and you take $1,000 and it turns into $10,000. You win. Stop looking for 1,000,000% gains. It's not going to work. Most people don't get it. Most people don't experience that. If 1,000 people try that, over 900 people are going to lose everything. It's not worth it. Long-term bag for show. Yeah, I understand. I appreciate the sentiment. All I can do is encourage different behavior, better behavior. Find your next step. Find what will make your portfolio choices and actions better, and then pursue better. Igor, Bitcoin pumping. Did J Powell just say something? No, it's just Bitcoin pumping. It's cyclical. I mean, look at this chart. This chart is awesome. Ethereum looks great. Bitcoin looks great. Man, when this thing gets over 3.45, Bitcoin's going to be pure fire. So Bitcoin, I currently hold full risk on. I do leverage it using MakerDAO at the moment for a stable 4.5% interest rate. So, I take my risks. I take different risks. I don't hold almost any asset, and I'm very willing to sell an asset. I mean, I do hold assets. I'm sorry, but bear in mind, my Cosmos is 5% of the portfolio. Bear in mind Cosmos and Polkadot, and if you do Cardano, I would probably have like a 2 to 4 year time horizon and position size. If you got 50% of your portfolio in Cosmos, you're doing wrong. You got 50% in Cardano, you're doing wrong. You're taking excessive risk and you're going to get burned. You may not get burned, you might get lucky. But that's the point of risk. With great risk comes great reward, but with great risk comes great pain most of the time. Bear in mind, just like Cardano is yield bearing, Cosmos is yield bearing. So I would probably put Cardano in a comparable position to Cosmos and Polkadot in that regard. It has great potential. There is still no TVL. How would you compare the projects? There's probably a lot of prep work going on in Cardano. There is, truthfully, a much more active development on Polkadot and Cosmos as compared to Cardano because you cannot build a smart contract on Cardano. I don't think that means much. I think once they're available, the development will accelerate significantly, and there's also a lot of money backing incentives. So, all things considered, I think there's great reason to put Cardano on par with the potential for Polkadot and Cosmos. None of these will impact Ethereum. Ethereum has too much network effect, and network effect means everything. And you shouldn't care. You shouldn't care. That's not the point. The point of these other platforms isn't a battle of who's right and who's wrong and who's better and who's worse. That's not the point. The point is you're allocating value and you want to have environments and ecosystems to be profitable. So stop with this tribal bullshit. You're wasting your time and effort. What you want to do is capitalize, produce gains, extract yield, experience appreciation, make money. You're wasting your time if you're doing this tribal stuff. What's better? Do you care do you really ask yourself, do you really care what's better? Or do you care what's better because you hope your asset that you hold will go up in value more? So you're using the it's better ideology to substantiate your value allocation strategy. That's a good one. Think about that one. YFI looks cheap. I'd have to look at the chart, but YFI you could get 40% interest on, 50%. 50% interest on YFI. YFI is basically the Dow asset for Yearn, and I think Yearn is going to be an absolute industry titan. Network effect, intelligence. TVL, facilitating a functionality that does not exist in legacy finance. Fundamentals tell you where to look, technicals tell you when. You get burned on YFI. And if you want to be protective against that risk, what you do is you take YFI and you pair it with a dollar stablecoin to protect the downside. You'll be exposed to YFI and experience appreciation, but you'll also have downside depreciation protection. Food for thought. Now we don't have to touch curve with those urn zaps, right, Carlos? These are crazy. These urn zaps are crazy. You can literally come right to urn, and you could deposit with Ethereum. That's crazy. Because typically you would have to go over the curve and deposit directly into the LP position and come back here with the LP tokens, which are these, the curve STF tokens. But you can now deposit directly with a variety of assets. I'm sure they'll expand this. Interesting that they defaulted with WCRES. That's probably because WCRES is basically partnering with the Aave in many regards, and WCRES is going to disrupt the crap out of the legacy bank system, particularly the ones that deal with family offices and families with like $500 billion stuff like that. Eth bounce. That's right, Powder Monkey. Eth is bouncing. I don't know about SCRT. I don't know about it. Ryan, what's your opinion on ACLX? Well, you're talking about an asset. With regard to Alchemix, that's a heck of a project. With regard to ACLX, that's a volatile asset that doesn't have a deflationary pressure. Just saying. There's a big difference between an asset and the project. So if you're buying an asset because you like a project, there's no correlation there other than psychological, other than social media and sentiment and momentum and stuff like that. Don't buy an asset because you like a project. Buy an asset because the fundamentals of the project make sense and the technicals of the asset make it an opportune time to make a purchase. And what if that asset's price goes down? Are you protected to the downside? Are you capitalizing on volatility, extracting yield? Things to consider. Stop buying assets because they're associated with a project. That's a trivial reason to buy an asset. Instead, step it up. Make an intelligent reason to buy an asset. You got to look at the technicals. You got to protect your risk. RB says touche. Franz, Digibuy is waking up. Digibuy needs to be like 16 to 18 cents to be bullish, based on the last time I looked at the technicals. I'll take a look real quick. Fun thing is 16 to 18 cents puts it much higher dollar denominator than the 2017, 2018 run. Now, for me, Digibyte has to go. It's waking up. Great, 30%. I'll come back to Digibyte when it's 100% to the upside. Exchanges often have a stop loss and limit orders. I want a stop loss or limit order to the upside. I want to place a bid on Digibyte when it's 16 cents and not have it execute right away. I want to wait for the asset to go up before I buy it. How about that for a contrarian ideology? It's not bullish until it's above its long-term moving averages on the daily or the weekly chart. That's generally speaking what's going on there. Well, my Digibyte fundamentals tell you where to look. Technicals tell you when. Palladium, no idea what it is, James. Wow on par with DOT. What is wow? Wow, World of Warcraft. So you have 90% of your portfolio in DeFi. That sounds a little excessive risk. Well, DeFi isn't an investment. DeFi is an ecosystem filled with countless investments. Powder Monkey 99 true RFB curve is really appealing from a TVL and market cap perspective for investment, but what are your thoughts on the whales farming and dumping? So the monetary policy of curve has proven effective. There's more of a deflationary pressure, which is exactly why it has appreciated. What's it at? 264. It's going up. Listen, it was down at 20 cents because of exactly the phenomena you're talking about. The whales were getting curve and dumping it for dollars. Basically, urine operates on that principle, curve STF. What it does, reason it gets 36% yield is because it's getting the incentivized curve yield, the incentivized emissions, and selling it for Ethereum. That's what it's doing. So the fact that the price has been appreciating means the deflationary pressure has overcome the decaying inflationary component. So all these DAOs have been well built from a monetary policy standpoint. Almost all of them have decaying inflationary components, which means their supply that's being introduced to the market is decaying over time, which is exactly what Bitcoin is. It's a decaying inflationary protocol. Um, what rounds off the decaying inflationary component is the deflationary pressure, which is basically why Ethereum and EIP 1559 is just really going to be serious. They'll have what many are speculating to be a deflationary component. We'll see it when it comes to fruition. Until then, we're still speculating. RB, especially seeing that the urine vaults make sure curve pools. Yes, exactly. Urine vaults use curve pools. That's exactly the point, and that's where these compounding APYs auto compounding come into the picture. Please hit the likes, people. 50 people in the stream, 32 likes. We can do better. Is there a tool to calculate risk adjusted yield? So cost of downside insurance, things like ALCX. Well, I don't think Armor supports ALCX at the moment, Alchemix. So no. But basically, look at the yields. The cost of insurance 3.84%, and if you go over directly to Nexus Mutual, you're probably talking about I think 2.84% per year. So you could yearns in here, and there's a bunch. Oh no, I didn't want to do that. And manually, I mean, there's a lot of platforms to choose from that you can insure. So insure your assets. Take a risk, but insure it. Curve's in here if you want to insure Curve. My opinion, the majors have been de-risked. I have an insurance policy because I want the armor rewards. I might as well get the insurance also. I want the armor, so you get 170% APY on your monthly expense, and I get the insurance, which is nice. But I have a 1-inch launch there, liquidity mining for the perfect pools actually. So one of the pools happens to be 1-inch USDC. You guys know what I'm talking about right there. Risk mitigated 1-inch exposure. Yeah, there's no doubt that's one of the few charts I have up. You guys can imagine why. Large allocation going on right there. Earning interest, dollar denominated stability with the stablecoin pairing. Bet you bottom dollar. Anyway, I wanted to share with you guys these thoughts. This is a lot of stuff that we've talked about over the months. Risk mitigation, dollar stability, downside protection, or just merely considering risk as a start. Are you taking excessive risk? Are you buying an asset and hoping that it goes up and not prepared for when it goes down? And that's something you shouldn't do. You shouldn't just buy stuff. And that's like Wall Street bets. And that's kind of why I named my channel Noah Street Bets, because I wanted to kind of do what they're doing and tell people they have to allocate value. They have to buy assets because holding fiat is a guaranteed loss of value, but holding assets, you have risk. Risk is better always than a guaranteed loss of value. There is now currently absolutely no reason to have anything more than you need in dollars. You need dollars for paying debts, paying bills, fulfilling obligations, buying things. That's it. It is wrong to have anything more than your monthly expenses in dollars. You hold it in dollar stablecoins and you get 20% interest without blinking an eye. And if you're worried about it, insure it. Ensure your curve position. Ensure your yearn position, either through ArmorFi or Nexus Mutual. And that's how you mitigate and manage your risk. Yearn plus Zaps are the way. Yearn and Zaps are absolutely cool because for most persons just entering the space, they don't know what the hell a curve STF asset is. But now you can deposit Ethereum directly. You can deposit Ethereum here and get 36% on your Ethereum. What's the problem with that, or the consideration? What happens if Ethereum breaks down from this somewhat symmetric triangle, maybe an ascending triangle, pushes down through the guppies and starts an almighty risk-off retrace where the deflationary implosion of the legacy financial system takes hold and the dollar goes vertical to 100 plus and bonds go negative interest rates and minus 5%, and it's literally like the world is ending. What if that happens? Are you prepared? Dollar stablecoin positions will be protective, which means will give you more time to exit the position and preserve more capital than less. Obviously, there's all the reason in the world right now not to be full risk off. These are bullish trend formations, and the legacy financial system is not imploding yet. But when it does implode, you need to be ready and know what to do. Because if you don't know what to do, you're taking excessive risk. Anyway, calculating the yield risk protection fees need to be easier. Until then, it was sure. I mean, but that's all about education, really. The UIs will get better, but this is some sophisticated shit. Most people don't think in terms of yield. The general public doesn't think about it at all because they clearly give their money to banks that give them no yield at all. So most people don't even think about interest. They think the only way they could get money is trading time for money. That's the biggest fallacy of them all. That's the opiate of the masses, and that's really what the system is designed to do. The whole system is basically designed to convince people to trade time for money, to contribute to GDP, to grow an economy. Yeah, okay. The system is geared to control the masses. Well, it's still too technical for most, and that's why I started this channel, because I wanted to show people how to take risk in a considerate way, in a protective way, because risk is better always than a guaranteed loss of money. Therefore, the only logical course of action is to take all dollars other than what you need to pay bills and apply it to risk positions rather than being guaranteed to lose money. And then you take those risk positions, you gain your intelligence and grow, and learn, and you learn how to protect the investment, how to achieve risk adjusted returns that are pretty much guaranteed to outperform minus 15%. You can literally get 0% on on risk assets and outperform the dollar. You can outperform the dollar under almost all risk-adjusted circumstances than a deflationary implosion, which is why you need to be prepared for a full risk-off event. Let's go back to Bitcoin one more time. So a full risk-off event and Bitcoin's going straight down. It'll go back to 1. It'll just get hammered. It'll probably find its way to the guppies. It'll get cut in half. And if you want to know where downside targets are, it's Willy Woo. You find Willy Woo. Now you look at his data. And there's some great examples of downside targets. JD concerns me with the 1-inch pool only being open for 1 month. Lots of cost in and out. Sure. All right. Then you can't apply your value there. But if you're going to throw in 100 grand or 200 grand, I mean, that's why these systems are working. Listen, if you're going to go over to BSC for 20% yield on $1,000 and then you're going to get $200 a year, is that what people are doing? That's what people are doing. And you know what they're doing? They're getting pushed around and value is getting extracted from them by the whales. Because the whale is throwing around $500,000 in pancake swap and getting all that cake. And what are they going to do with it? They're going to dump it and sell it to people that have $1,000, $2,000 portfolios, and they'll buy it. So the whales have all the power. So the question that smaller portfolios need to ask is, how do I capitalize in these markets knowing that the persons with large portfolios are predators? So you can't just buy assets and hope they go up because there's predators. So what do prey need to do? Prey need to learn how to navigate the forest. And they do call the Ethereum the dark, a good part of Ethereum the dark forest, actually. There's a lot of research that goes into it because there's predators out there. And if you have a smaller portfolio, you are prey. And this channel has been created to show prey how to navigate the forest. The odds are the vast majority of persons with small portfolios are best suited for dollar stablecoin paired LP positions for risk on, and then you switch to dollar stablecoins for an Aave for risk off. That is the logical strategy. You shouldn't be holding volatile assets risk on. I don't even opt for holding volatile assets risk on, and I'm not a whale. I'm also not a small portfolio. But even for me, that's what I want to do. I want to protect the value. I want to protect the value more than I want to make the value. Now, for the smaller portfolios, that's even more important. You got $5,000 in crypto, you have even more of a necessity to protect the portfolio. And if you're younger, you have more of a reason to protect the portfolio and grow your principal over time because you have time. And you will be working and you will be converting time into value, which you can then use to grow your principal, which will be compounding. And Einstein said compounding is the eighth wonder of the world. I don't mean that in a derogatory way, Angela. I mean that in a real way. And it's not a bad thing, but it's true. Meaning you're the little bunny rabbit and there's wolves out there. And you know that's the case. You know it. And folks have known it. Because they always say, oh, the whales are pushing around the market, but you haven't thought about how to strategize it and how to take the next level and apply it to your value allocation strategy. So we're going to do this again tomorrow. I've been way over on time today. Let's keep it going. Let's educate. And let's take that next step on how to do better and how to take risk mitigated decisions, how to pursue risk adjusted returns, and how to protect your value and grow it at the same time in a time where it's minus 15% on dollars, and we have to do it. Thursday, March 18th, 12:17 p.m., 40 people in the stream, 36 likes. We did better. As always, I thank you all for joining, and I will see you tomorrow. Peace.